Today we have Davie from Box Advisory Services, who runs a very successful accounting firm. Today we'll be discussing the most recent budget announcement, instant asset write-off, fringe benefit tax, and certain things business owners should look out for when it comes to purchasing assets under their business. All right, Davie, thanks for coming on, mate.
Yeah, thank you for having me. No. I'm actually really excited for this.
Me too, man. Yeah. I'm really pumped, man.
This is my first podcast of the year, surprisingly.
That's a lie.
No, seriously.
Really?
Oh, yeah, no, for the other podcast, yes, but for business and accounting and tax, first one.
No, that's good. I appreciate you coming, man. Just for the audience, you want to give us a bit of background on Davie Box Advisory Services, how it all started, where it's at now, just to give a bit of background for us.
Yeah, so I've been doing accounting for, I think, about 16 years. I started when I was 17, and I've just been doing accounting from like day one. Yeah. So the reason why was, mum and dad, Asian parents told me, hey, you got to go to uni, you got to study. We come all the way from Vietnam and China to come to Australia and for you not to have an education. So they wanted us to do something that they thought was good. And I chose accounting because it was business related. And I thought at that time it would make good money. Bad choice in making money. Took me about, 10 plus years to finally actually make some decent coin. The rest was history when it comes to starting my own thing when I was 26. And it's been really good. We started with just myself. And then a few years later, I hired my first employee. And now it's 7 years, I think, right this year. And we've got about 25 people working. Yeah.
Awesome.
Offshore and onshore.
Tell us about that transition from working for a company, going your own, hiring staff, a bit about that process.
Yeah. That process was, it was tough because there's a big difference from working for someone and then going self-employed. Being self-employed. But then there's also a difference between being self-employed and being a business owner as well. So there's 3 stages. So I'm starting to cross over the last couple of years I've crossed over to business owner. But first time working for someone, you work 9 to 7 p.m. But once you clock off, really. You still think about work, but your mind isn't racing. But when you're self-employed, you're racing nonstop, 24/7. However, your bosses are your clients. And then when you become a business owner, it's so different. It's still 24/7, but you're really working for your staff. So you're always people management, making sure that the business still runs and you're learning to let go. Definitely. And empower your staff. So it's very different. Yeah.
It's very important. I always think to myself, if I was a one-man show, didn't have staff, wrote the deals, you probably make more money, right? But it's about building a business that runs itself. And I think you've done a great job making that change, but also going out on your own, hiring staff, and the business is running without you. I think that's the biggest challenge as a business owner, right? Is taking that leap and, getting out of your comfort zone and getting people to do the things that make the business run and you can focus on working on the business.
Yes.
How many staff do you have now?
About 25, yeah.
25 staff.
Internal, offshore and onshore as well. Yeah. So
awesome, man.
Bit crazy. Yeah. It's so tough and I wouldn't wish it upon anyone to go through that stress. It sounds great. It sounds amazing. Yeah. But seriously, 24, I just came here today and the first thing I said to you guys was I just left a shit show at work and I'm going to have to go back and fix it because something happened internally and that happens pretty much every day and you just got to roll with the punches. But man, I wouldn't change it for anything because maybe
if you knew the journey, how hard it was going to be before making that decision, you probably would not have done it, right?
Maybe there might be a chance. But I think it's really rewarding coming to a company and coming to work every day to see what you created, but also the team, empowering the team. I talk to the guys at work and it's just that's the part that I love the most.
They're growing with you.
Yeah. I love the most of seeing that some guys start with us and then being able to, advise his own clients and, they call the office to speak to him, not even me. They don't even know who I am, which is insane. That's the cool thing about running a business and empowering your staff. And then your staff love it as well. It's like your family as well.
Yeah,
at
of
home.
Course. Yeah.
You see your kids growing up, you see your parents and everyone getting old together and enjoying the parties together. Same thing that happens every day with us. Yeah.
No, 100%. And you never know, building a business like that, people are working with a company. They're not working with one person. And obviously, if everyone has the same sort of motive, everyone's striving towards that same mission, that vision, the outcome for the customer is always going to be better because you've got more hands onto the deals, into the customer situation. So definitely. The reason why I touched on that essentially is I wanted to talk about new school versus old school accountants because obviously it's very evident in your business that you've implemented technology, you've gotten staff, you've gotten some resources and you're using all the latest softwares. how important for a business owner that's looking at an accountant to go with an accountant that has all those things down pat, because we see still customers dealing with, the traditional old school accounting, everything on Excel spreadsheets, nothing up to date on, Xero and MYOB. If you can give us a bit of a background on how important it is, for a business owner to engage with an accountant when they've factored in all those things like implementing the new softwares, latest technology and whatnot.
Yeah. I guess it all goes back to what the clients want, right? The clients want, and what from my 16 years of doing accounting, is they want a accountant that's transparent. Like, they communicate really well. Transparent in a way where the costs, they know what they're paying for. They know upfront that this is the amount that they're going to be charged. That's one thing. The second thing is communication. They want someone that's accessible and cuts through all the bullshit about like jargon and all that stuff. I see some clients coming to me and they say, my accountant, I used to go to him or go to her, and I thought I knew what I was doing until I have a meeting with him. And after the meeting, I feel like I don't know what I'm doing. So accountant's supposed to make it clearer for you, but some accountants just don't communicate well, or some accountants don't even exist. Like you can't even get a hold of them. And then the third thing is like helping you understand like your books and your accounting and your taxes and stuff like that. So being there to educate you rather than just doing the books, doing the taxes and telling you how much to pay. There to give you personalized service and educate you. So they're the three main things that most small businesses want. And from that, I grabbed that and realized that our old school way of doing things, it wasn't really like that at all. We were more like bean counters. We'll get the data from the client, work out what the taxes will be and give it to him and say, this is the amount of taxes. We'll have a few touch points throughout the year. And some of the touch points were related to sending you a bill and telling you to pay us. And then the other points is like telling you how much tax there is. And the other part, like there wasn't really that much communication on advice and going, understanding what the client wanted. And that's the problem that I felt like old school accountants were doing. And to be honest, like I had that bad habit as well. And that was because of the way accounting was 10, 20 years ago, when it used to be very bookkeeping driven and data processing driven. That's how accountants were, but now it's evolved because of technology. So technology has came in, it's kind of got rid of some of the bookkeeping and data processing. So it's not needed as much by the accountants. So accountants need to kind of change and evolve and start doing more advisory work and helping the clients out with like, their business and their decisions.
Of course.
Yeah.
I think that's very important because, you'd be surprised, Davey, how many customers we speak to and we ask them, hey, can you jump on your accounting software and just download this document for us? And they'll be like, accounting software? And I'll be like, you don't have an accounting software? They'll be like, no, I'll need to speak to my accountant. And the biggest thing when I engaged with you to look after Odin Finance for our work is you set us up on Xero, but not only did you set us up on Xero, you educated us on how to use Xero. And I think for a business owner, that's so important, having an accounting software and understanding your own financials, right? Because if you can't understand your own business and how it's tracking, how are you going to be able to make moves? How are you going to be able to grow? You want to know at the end of each month, you can download a P&L and see where the business is at. You know, what the bottom line is, how much you're spending, and if you need to make tweaks on expenses or you're making good profits so you can expand and purchase more equipment or hire new staff. That's why I want to touch on that, because the accounting software and all the latest technology is going to only help business owners and help you as well, because the more the customer is educated, very similar in our type of business, the more the customer is educated, the better you can serve them. And if they're more educated on how their business is running and they have their accounting software, less phone calls to you, right? And it's just happy days for everybody. So
it's happy days of the external stakeholders as well. Like, the finance, the banks, they can tap into Xero. And a lot of clients are saying, Davie, I don't want them to know too much about my business. But I'm telling you, like these days, the ATO or the government can just ask the banks anyway. They feed all that data to the government anyway. So
it's such an important point. I think I can't remember exactly what country it is, but I think eventually in the next, 5 to 15 years, give or take, I think that the lenders are going to have access to everything. They just jump online to the system. They'll be able to download any reports if you apply for credit with them. And it's so important because if you traditionally now, customer goes to the accountant, they need to get financials, and some funny business might happen. I don't think any of that's going to happen in the future. Everything I feel is going to, the more technology advances, right, they're going to have access to those things. So it's going to be sooner or enough, especially with AI, all this technology, sooner or enough, these lenders are going to know everything about your business. So why don't you be a bit more prepared, get a bit more organized, understand the software, get up to date with things so you're well managed. And in terms of like asset finance, because that's what we do, right? It's become very clear that a lot of people are just financing their assets. It's just become a no-brainer. Back in the day, a lot of people were just paying cash. They were unfamiliar with the process. And essentially what we wanted to touch on is, why do you think business owners have changed so much to opt for financing rather paying cash? If we rewind 15 years ago from now, compare it to now, a lot of people are well aware of financing assets under their business. What do you think's changed there in terms of customers and, you know, them knowing when to finance and when not to finance?
Yeah. Well, the first things first, I'm not an expert in this because 15 years ago, I was just starting to do accounting. And
have you seen a change though? When you first started doing accounting, have you realized more people now are financing?
Yes, definitely.
Before back then? Yeah.
And my opinion of it, so opinion only, is that back then the interest rates were a lot more higher. So that's one thing. And the second thing is people didn't have, it took too long to get the data to give to the banks as well. So back then, like, you know, you had to do the bookkeeping, processing, and all that stuff. And it would take days not even days, months for the accountant to get the information in, unless you had an internal accountant. But back then you would have to wait 1 year or 6 months for your financials to get prepared by the accountant. And so they couldn't provide that documents to the banks fast enough, so they couldn't get the loan. And also the interest rates are a lot higher. And I know people are saying, hey, 6% interest, 7% interest, that's a lot of interest. But, you know, speaking to some of my older clients that I've been working with, and I say, oh no, interest rate's really high. They say to me, Davie, man, back in the day, I've been in business for 40 years, but back in the day, the interest rates were a lot more higher back then. So getting a loan is actually not that big of a deal, even though that, you know, back then the interest rate was 3-4%.
Yeah.
And now it's 5 to 6. It's still not that bad. Well, two of the reasons why I think a lot of people are going into lending. The cost of spending your own cash when you can deploy elsewhere to get you a better rate of return.
Yeah. 100%
is another thing as well.
I always say to customers, if you're going to put money towards purchasing an asset, right, it's going towards a depreciating asset. Why don't you use that capital that isn't easy to build up to something that's going to appreciate in value?
Yeah.
So, and I think that's starting to happen now. And, you know, even though rates have started to climb up slightly, we're still seeing a lot of activity there, which is good.
Yeah.
What I want to touch on, so we mainly deal with commercial applicants, right? So business owners, when they're looking at financing assets, they're looking at obviously 4 different finance options. So you've got your chattel mortgage. So that's when they own the asset from the get-go. They get to claim depreciation, interest, GST. You've got your finance lease where it's sort of off balance sheet and, you know, doesn't show up on their liabilities and it's like a lease payment to the lender. And then you've got your rentals, right? In certain situations, we always speak to the customer. They'll be like, what option is best suited for me? And I'll be like, look, I can give you the ins and outs of each facility type. However, it's up to, you need to speak to your accountant to see which option is going to be best suited for you. And what I want to touch on is, I'll be honest, 95% of the deals that we do are chattel mortgage, right? So that's when they own the asset from the get-go, that they can claim the GST upfront in the next BAS, and it just makes sense for a lot of business owners. However, there's some businesses that opt for a finance lease and rental. And are you ever having those conversations with the customer where you're trying to work through the customer and see which facility type is going to be best suited for them? And when would you say do a finance lease? I know chattel mortgage is the most common one, but when would you say to do a finance lease or a rental?
Yeah, and I agree. Chattel mortgages are probably the way to go. And basically that means you take on the asset and you own it, and then you borrow money to finance the purchase. So that's the main one, because for tax purposes in Australia, that's the best move because you get to claim the whole thing up front.
Yes.
And these days, until 30 June, you get to claim, even if you purchase an asset over 100K, you get to claim the whole thing up front, which is really good for tax purposes. So that's why the government's pushed for that. So therefore, a lot of people have been trying to purchase the asset outright, and you only can do that using finance and chattel mortgages. So that's the most important thing. But the reason why some people would opt out of that and prefer to go for something like renting or leasing, which is more, you don't get to claim it up front, but you claim the payments as you go, so the monthly repayments.
Yes.
So you only get a tax write-off on the monthly payments. That one there is only useful when, one, you don't really want to own the vehicle, the asset. It doesn't have to be vehicle, but the asset itself, because it's a fast-moving asset where you want to own it for a year or 2 years. Well, not own it, use it, utilize it for a year or 2 years, and then don't have to worry about selling it off later. You just borrow it, renting it, and then leasing it or some sort, and then give it back to the original owner, and they had to deal with changing the part or selling it off. And that happens a lot with forklifts. I find a lot of business owners these days they ask me, or should I lease it or should I buy it outright? And some of them buy it outright because they have the cash out there, but some of them don't have the cash and they don't want to deal with trying to sell the forklift later on down the track, they'll rent it or lease it instead. Another very common case would be photocopying machines. No one wants to deal with a photocopying machine and own it outright, so they lease it for 12 months, 24 months, and the technology or the photocopying machine will get upgraded, and then after 1 year or 2 years of use, it's kind of useless to you, and you need to buy a new one. So
that's
you buy a new
example.
one. Yeah.
So we see like when it's off balance sheet, right? The finance, lease and rental. Have you ever said to a customer, just out of curiosity, like they're a very strong, profitable business, right? And I wanted to touch on the differences between the chattel mortgage and the lease in terms of claiming the repayment. So if, for instance, someone was purchasing a very large forklift for their business, which was very profitable, and the rental payment was like $2,500 a month, just for the audience to understand it, is that $2,500 a month multiplied by 12, that completely offsets their profit. So they're paying tax on a lesser amount. So if they made 100K profit, and let's just say their annual repayments were 75,000 for hiring this forklift or leasing this forklift, does that completely offset so they only pay tax on the 25 or 20K?
Yeah, the way it works is the tax system in Australia is, there's a myth that if you spend 75K in repayments or expenses, you get to claim the whole thing back, and you get like the 75K back into your pocket. So that's not true at all.
Yeah.
The way it works is that, let's just say you made $100,000 and your company tax rate is 25%. It's owned under the company. If you didn't pay for the 75K and you didn't have the forklift at all, you would make $100,000 at the end of the financial year. You'll pay 25%. That equates to 25K, and you pay that tax. But if you take on that 75K expense, then what would happen is that will reduce your profit from 100 to 25,000, and you pay tax on 25K times 25%. I don't have a calculator with me.
No, that's fair enough. No.
But that's how it works. So you do save, but you only save that tax rate, the 25%. Yeah.
And how does that differentiate between a chattel mortgage? Because they're not able to claim the full repayment in a chattel, right?
Yes.
So the repayments, if same example, it's $2,500 a month, but they own the asset.
Yeah.
They only can claim like certain expenses out of that, right?
Yes.
So in terms of saving from a profitability standpoint, there might be some added value doing a finance lease or rental if you really need to offset some of your profit, because you can't claim the full repayment for a chattel, right?
You can't claim the full repayment on a monthly basis, but you can claim the asset outright.
Yeah, okay.
The asset outright.
Yeah,
so when you purchase the...
Well, for now anyway.
Yeah.
Till end of June.
Yeah. Well, yes, it's true. So what's happening is that there's no limit right now. It's called the temporary full expensing. So basically, you purchase an asset that's over 100K or whatever amount it is, you can claim the whole thing up front if you purchased it. So the great thing about hire purchases or chattel mortgages is that you borrow the money and you own the asset outright, so you get to claim the whole thing up front. But yes, when the rules do change, then it might be a good idea to
consider a finance lease or rental.
Yeah, because finance lease 75K, you get to claim it up front, as opposed to claiming a portion of it for depreciation purposes. Because when the rules change and the asset is more than $20,000, then you have to do depreciation. Depreciation is basically, for the guys that are out there that don't understand, is you get to claim the asset on the useful life of it. Meaning that if you purchase a car, for example, the ATO thinks that you use the car for 8 years. So you don't get to claim the whole car. Say it's $50,000 upfront. You have to claim it over 8 years. And that is quite a long time. And repayments on a car, you probably would rent it only for 2 to 3 years, or lease it for 2 to 3 years, and you'll probably sell it off straight away. So 8 years is a longer time than 2 to 3 years of claiming of lease payments or rental payments. Yeah. So I get your point there.
Yeah, it's sort of like a double-edged sword, but because generally how these rentals and finance lease work is, you have the asset, that full repayment is being expense. However, at the end of the term, they generally need to pay for a rental, sometimes fair market value for the asset to own it if they want to own it. And if it's a finance lease, there's a mandatory like residual component that they might have to pay, which they probably didn't want, right? So you're getting the benefit there, but then you've got that thing out there. So it's something to have that conversation with the customers and make sure they're aware that these are the ins and outs of each one. But that was a very good example how you used the forklift one. I like that. Yeah. Big topic that I want to talk to you about is fringe benefit tax, right? It's a hot topic. We're hearing it a lot more, and a lot of customers are starting to understand it a bit more. But just for the audience that don't understand it, can you just give us a brief dumbed down version of what fringe benefit tax is?
Yeah, you're probably hearing about it more because accountants are finally getting like a bit smarter. So most accountants ignored it a lot. But the way fringe benefits tax works is that back then, obviously, we used to pay a thing, and we still pay this thing. This thing is called wages and salaries. We used to pay that, and we still do it. And that still gets taxed. If I give $100,000 to an employee to attract them to work for me, I have to pay about $25,000, $26,000 in taxes, withhold that amount and pay it to the government. So they only get like, what, $74,000, $75,000 in their pocket. So what employers started doing was giving them a personal benefit to attract them to come to work for me, which is like, for example, a personal car. Hey, work for me and I'll let you use this car for your personal use, like to take your family out, you know, go on trips together. You get this car to do whatever you want. It doesn't have to be just for work purposes. And then you technically saved in taxes because that money didn't go to you because you would have used the extra money to pay for this car anyway. But instead now you got this car to use and you don't get taxed on it. So and then the ATO came along and said, hold on a second, this amount should have been a wage. So therefore we're going to implement a new tax system, which is called fringe benefits tax.
How long has it been around for?
That, my friend, I don't know. But it's definitely been longer than I've been doing things. So probably about 20 years plus. Yeah. So, but yeah, that came in, and the negative thing about it, and some accountants don't like this, to be honest, most accountants don't like fringe benefits tax. But the bad thing about it is the tax on that is 47%.
Yeah, wow.
So that tax rate is really high. And, you know, if you look at the tax tables, you know, the lowest one is 0%, and then it goes to 19 cents in a dollar, and then 45%. So you can see that FBT is even higher than the individual tax rates. So why use that? And so most businesses, small businesses especially, will opt out on trying to
avoid it.
They will try to avoid FBT. Yeah.
We're seeing a lot of customers coming and saying they want to finance the car in the personal name because their accountant advised them that they're going to get hit with FBT. And that's something I wanted to touch on. You mentioned the instant asset write-off and claim of deduction. What people don't realize is you can't just go and buy a G-Wagon under your construction business and claim the full deduction on that car. There's a cap there, there's a threshold, and there's also FBT implications, and there's also GST implications if they decide to sell it in the future. And a lot of people think, hey, I'm going to buy this $200,000 vehicle under my business, and they think they're going to claim the GST on the full amount. That's incorrect. Can you give us a bit of a background on how people buying cars under the business, what's the thresholds, what's it capped at, what are some things to be careful of, you know, some advice to some of the audience?
All right, this is a long answer, so bear with me with this. So I have to explain the 3 different taxes. So fringe benefits tax I explained, but I also didn't explain how the calculation works. Basically, if I give you a car to use and you're my employee, and I say the car, you used it for a whole year, and I calculate the value of how much you used it for, expenses, repairs, and the depreciation of the car. If I equate that to be about $20,000 for the whole year, say that you used 50% for business use, the other 50% is private. The tax office wants to tax 47% of that, the other 50%. So $20,000, 50% of that is $10,000, and $10,000 gets taxed at 47%. So you pay 4.7K of taxes. That's how FBT works. So that the government wants to collect 4.7K from the employer. So that's how FBT works. Income tax returns works a bit different, which is how I explained with the scenario with the 100K and then spending 75K for a forklift or equipment. So if you make 100K in taxes and you purchase equipment and that equipment was 75K and you get to write the whole thing off, then you get to save 25% tax on the company tax rate. GST is a completely separate tax as well, which is so confusing. But if you purchased or spent 75K, you would have 10% GST as well. So that 7.5K of GST, you get a claim back straight away in your business activity statement. So there are 3 different taxes, and you have to like pay attention to all 3 because all 3 of them impact each other.
It's very important.
Yeah. So
and aren't certain cars sort of capped at like 54,000? Was it?
Yeah, 54K. There's this new, well, it's not a new rule. It's car tax limit. So basically the tax office realized that a lot of people are spending a lot of money on cars because, you know, that's the biggest chunk of claim that you can make on a business in so little time. Like you can do it, you can buy a car in the next day if you wanted to. And then you get a claim like, you know, $80,000 or 100K. So what the tax office realized is that people were overspending on cars. And they're like, you know, hold on a sec. We can't like encourage people to spend too much on cars and claim the whole thing. So they put a limit on it. And that limit is $54,000. So if you spend over $54,000, you can still only claim $54,000 for income tax purposes and GST purposes. So, you know, that case where a G-Wagon, how much is a G-Wagon these days?
300, 350.
Yeah. So if you purchase a G-Wagon in your company, for example, thinking it's the best idea, and you think you can claim 300K off your profit, That's not the case at all. There's a rule in there that's called the car tax limit. It will limit your 300K down to 54K, and you only get to claim 54,000 of that 300K against your income tax. And then it also limits your GST, and you only get to claim 5K, even though you paid $30,000 in GST. And the worst part is when you sell it.
Yeah, that's what people don't realize.
Yeah, and the accountants don't say anything about it because one, they may be too busy, or they don't really have the time to even educate the clients about it. But when you do sell the car, you'll be selling the car, say 200K, 250.
You got to pay
$25,000, but you only claim GST of 5,400,
and there's that ongoing FBT they need to pay every single year.
Yeah.
Which, like, it's hard to say. I know it's case by case, but we'll use a construction owner buying a G-Wagon.
Yeah.
I don't know what percentage of that they can use for business use, but on a rough figure, how much FBT would they be paying on a car like that for a construction business, roughly?
300K. I don't like. So I'm an accountant, naturally a tight ass. So I don't know actually how much you would spend on a car, but say you spend 60,000 a year on a car like that.
Yeah.
Yeah, 60,000. You would pay, and then you use 50% for business because, tax office really brings it down. Say 50% for business, so 60K, $30,000 is your benefit, a fringe benefit. So 47% of that amount is
per year.
Yeah.
So 15 grand a year.
Yes, you'll have to pay 15 grand to tax, and on top of that, you're paying 60 grand to own the car
plus interest.
Yeah, plus interest. So like you can see that it's not really that worth it.
Yeah.
That's why
it's not really wise.
Yeah, that's why
there's no creative accounting skills to get around this, or
well, there is something called like the electric car, fringe benefits electric car that came out, the exemption, where now that the tax office is trying to encourage people to use energy efficient cars, and so therefore the limit's pushed up to 84K, and you don't have to deal with FBT. There is also I wouldn't say it's a loophole, but if you purchase a car that's considered a work vehicle, which is 100% a work vehicle, like a ute or a van.
And you're in construction.
Yeah, in construction.
Or something.
Yeah, something like that. Yeah. Then the tax office sees it as this is a work vehicle. There isn't any personal use percentage on this car. So therefore, you get to claim the whole thing up front. Yeah.
And something like that example that you just gave, you in a construction business, you don't even need to have the conversation with the ATO. It's sort of just obvious, right? Yeah. They're buying a ute, they're in construction, no FBT.
Yeah, there are specific rules, like it has to have it has to be able to hold over 1 ton and all that stuff like that. You have to go into specifics, but most generally utes, it's good. Yeah, most utes are included. There are some like very expensive utes. Don't ask me. I don't know which ones are expensive.
The Rams.
Yeah, they're the ones. Yes, the Dodge Rams or something like that. Those things there, I think they excluded. Yeah. So you can't go spending like 150 grand on a ute or something like that. How much are those ones?
We did one 150K or 160K.
For you?
Yeah, they're like a truck.
Yeah.
Okay. Yeah.
It's pretty cool. Pretty cool. Yeah, but those ones
they
are
look
excluded.
nice. Yeah. So they probably won't be able to get full deduction on that, right? That's interesting. How often are you having these conversations with cars? Because I'm sure you get the phone call, at least a couple times a week. Hey, Davie, I want to buy this car.
Yeah.
What do you think I should do? And you're like always opting to go personal name, right?
Well, yeah, it depends.
Like, mainly if they're buying like a luxury car, it's not an electric vehicle, so they can't get that 84K deduction. Yeah. But, for all the luxury BMWs, for all your Labo clients or your Arab clients under the business, how often are you having the conversation with them saying, hey, it's not wise to do it under the business? Because not only are you going to get smashed with FBT, if you sell it, you're going to pay GST on what you bought it for. You only claimed, $5,000 when you bought it.
Yeah.
How often are you having those conversations?
I literally have those conversations literally every day. Yeah, so we get those calls. There was actually one funny story. It was actually not ethnic at all. So they called me up, and I was actually in Japan in the supermarket trying to buy food for dinner. Yeah. And they called me up and like, hey, Davie, this is a really urgent question, but I need to buy a car and I'm purchasing a car right now and I need to know where to buy it on. In his case, it was actually better to purchase it in the company, partly because he was buying a van for business use mainly. It really depends. Like sometimes clients would purchase a car, for their spouse, and their spouse does a bit of work for the business. Then there's a difference where maybe you might purchase it in the business and maybe you might rather purchase it in your personal name. If it was an electric car, for example, 100%, and it's under $84,000, 100% put it in the business because you get the FBT exemption straight away, and you get to claim the business 100% use of the car. So it really depends on what you're purchasing.
Yeah.
It also depends on how much it is. It also depends on what type of vehicle it is, and also depends on what type of industry you are. They are like the 4 main things I normally ask. Also, how much cash do you have as well?
Of course.
Yeah.
The problem is, as a broker, it's so much easier to get the deal over the line under the business. There's less red tape. It's not regulated under NCCP. A lot of the times we don't need to demonstrate serviceability with financials if it's not a large amount, and rates are generally better. So, we always have customers say, hey, I spoke to my accountant, I can't do it under my business, I need to do it on my personal name for FBT. And then you dive deeper and say, okay, that's fine. Let's explore that option. And we have a look at their individual tax returns, and they're showing a very minimal wage. And on paper, they can't service it. And a lot of these car loan providers aren't factoring in company profits when it comes to getting finance in their personal name. And it's a tricky one because you're like, all right, I understand why you want to do it in your personal name. We can do it in your business, no problems. It'll be clockwork, straightforward, sharp rates, mainstream lenders. However, you can't because of the FBT. Let's look at the personal name. And then being a business owner, they're not paying themselves a big wage. So it's a really tough one. How many customers come up to you and say, the broker's saying it's too hard to do in my personal name because I'm not paying myself a big wage?
Yeah.
Does that happen often?
For my clients, no.
Not really?
Because of my habit. I don't know. Maybe...
You get them to pay themselves more.
Yeah, because... I had the conversation today with the client because this is... it's May right now, so we're having end of financial year meetings. And the client always says, why am I paying so much tax, Davie? I'm on $120,000, $150,000 in taxes. And I do the maths with him, and I do this pay calculator scenario with him. I go, if you pay yourself $100,000 and you slot that into the tax calculator, you actually work out effective tax, pay $26,000 roughly, $26,000. If you took that $100K and left it in the company, you pay $25K in taxes. The taxes are similar. Why not put it in your personal name, and then you get the money, and then you can purchase assets and personal assets in your name, and you get to enjoy your lifestyle. Because let's face it, in Sydney, you need at least $100,000. I don't know why people think that they can live off $40K, $50K a year. It's really hard, especially when rent is so high. So you need about $100K to kind of survive, especially with a family. And
getting an approval for a mortgage.
Yeah.
You're going to need to demonstrate a big wage.
Yes. Exactly.
Even borrowing a small amount. So
Yeah. So luckily for me, I don't get that question because I try to educate my clients. But, a lot of people go, 25% tax rate in my company, and then 32% or 37% in their personal name. They rather opt to put all their profits or their money in the business. But I always say to them, no, you got to take some money out. One is you got to take some money off the business to diversify, to invest elsewhere. But you also should take some money and pay yourself because you need that money to survive. And we live in a society right now that relies on data to make decisions. So they rely on your tax slips and pay slips and your income tax returns.
Notice of
assessments and stuff. So if you don't show that and pretty it up and to give it to the banks, let's face it, the people at the banks, they're ticking boxes. And if you don't allow them to tick the box, you're not going to get the loan. So
story of my life.
Yeah. So you got to, for us, we educate our clients so we don't have that problem as much.
No,
but yes,
good that you do that.
Yeah.
But we do have an alternative solution. So if a customer is a director of a business that's been running 2 years and they own a property, we can low doc the deal in their personal name without providing financials. But not everyone has a business that's qualified for 2 years GST and own a property in their name. So in those situations when that's not the case, or they're looking at purchasing, something worth 300, 400,000, we can't do it as a low doc. We need to look at their individual returns. And I think there's something that needs to be done there because not every business owner can pay themselves such a big wicket, right? I think they should at least factor in company profits, even if they're the sole director of the business, to help these guys, you know what I mean? Because this FBT is very expensive if they want to buy the car or, if they want to do anything in the business. So we obviously see a lot of accountants, right, Davie, that refer us work. And a lot of them have been saying the same things. Fringe benefit tax, they're really, really cracking down on it. Can you give us some examples of how the ATO are cracking down on this? We've been hearing it only within the last 6 months, FBT really is smashing customers, you know what I mean? Can you give us some examples and why that's the case?
Yeah. Well, the big case is that 31st of March is when the FBT year ends. So that's why you've probably been hearing about it a lot more. So the accountants are doing their taxes for fringe benefits tax, and that's how your clients are finding about it and they're speaking to you about it. So that's probably why FBT is happening. But FBT has been happening for quite a long time, and the way that the government gets the pinpoints who needs to pay fringe benefits tax and who doesn't is mainly, especially for cars, when you lodge on your registrations on who owns the car, you lodge that with Service New South Wales or, Service Victoria or the other authorities. When you do that, the government has that information and they share that with the federal government and all the other government bodies as well. So they share that information to each other and they call it the data match. So therefore, the tax office comes calling and goes, well, you own a car in this company. Why isn't there a fringe benefits tax return lodged? Especially when the car is not a ute, it's not electric, and it's a sedan family car. The funny thing is sometimes when you see a Kia Carnival, it's a family car where all the ethnics use to drive all their kids around. Yeah, that there would get impacted straight away because they know that, hey, this car doesn't seem like it's used for business.
Yeah, it's personal, definitely personal.
Yeah. So then they would usually send a notification to the accountant, and that's how that works. Yeah, so that's how the data matching works, and a lot of people get caught out on that part.
What if the customer, let's just say the accountant didn't notify them of FBT, right? And they were driving this vehicle for 3 years and nothing was said. Has there been situations where you've onboarded a new customer and then you take over their thing and then, they've been driving this Mercedes Benz under their business and haven't paid FBT in 3 years? Did they ever come down and say, you owe us X amount because this car isn't for business purposes, you owe us X amount in FBT tax?
Yeah, the process usually is they will notify you that you need to lodge a FBT and then keep chasing you to lodge one. If you don't lodge one, they'll do a judgment and they will estimate how much you've spent. And then they'll tax you on the estimate. So most people would just avoid it and neglect it. But then if you do lodge it and the accountant does it right, then you can't make any adjustments and you can't do anything about it to adjust and reduce the FBT. So if you don't lodge the tax return, they'll do a judgment call and then they'll go estimate how much it is and you pay 47% on that. And my advice is once you get that notification, you need to do something and speak to your accountant straight away because there are ways to minimize that bill. Yeah, I don't know if you guys are interested in knowing how the ways to do it.
No.
Yeah.
No, I was just curious to see, if customers were just driving these cars, happy days, and then 3 years later, bang, FBT.
Well, that happens often.
Yeah.
Like a lot of people, and this is for income tax purposes as well, any stories. And I hear this so many times from clients. Clients always say to me, Davie, well, my neighbor or my family friend or my uncle, he drives this car or he's claiming all these things on taxes. How come they haven't been caught? They look like they're fine. My response to them is wait 5 years and then call me back and ask me. Because normally the tax office would go, one thing, it takes a while for the tax office to, collect the data. It doesn't just happen instantly.
Of course. Yeah.
The second thing is that tax office, it's not profitable and not feasible for the tax office to audit you on the first year. They'll wait 2 to 3 years because the tax bill is a lot more bigger and the money they can collect is more bigger. So then they'll collect the money then and they will do the audit then because they need to don't forget, they need to send the employee down to do the audit and that costs money for the ATO. So if the tax they collect isn't worth the amount that they spend to employ the auditor, then what's the point of doing the audit in the first place? It needs to be feasible as well. So they need to collect the right amount of tax. So it usually takes about 3 to 5 years. And obviously the audit can drag out to another year or 2 years too. So yeah, so that's why people don't get caught out and you see people driving fancy cars and you're wondering how the hell they can do that. Yeah. And I always say wait 5 years. And there are cases where they waited a few years and that same person,
gosh, that will hurt.
That same person, they say, hey, can you speak to my uncle? Because my uncle has a problem right now and he needs to get it fixed. And it's the same situation. And I'm saying, at least I told you so to that client and get your uncle to call me and I'll fix it up for him. Yeah.
Wow.
So it happens. It's happened so many times to me. Yeah.
I would hate that.
Yeah.
Let's talk about instant asset write-off. Obviously, that's a hot topic. And for asset finance brokers, we're getting a lot of customers come to us and say, I'm buying this machinery because I'm going to get an immediate deduction on their business. First thing I want to touch on is there's a misconception that cars are also capped, right, for instant asset write-off. So if the same thing, someone buying a luxury car in a construction business, they can't claim the full deduction, right? It's still the 54,000, right?
Yep, 54,000 roughly. Yep.
What I want to touch on is how important is it for business owners to sort of take action on with this instant asset write-off ending in June 30 this year to be able to claim that full deduction. And we just saw on the budget that they've changed that recently. So what I want to touch on is let's have an example of, a civil business looking at purchasing $150,000. If they were to do that before the instant asset write-off finishes in June, and let's just say they made $150,000 profit, they were estimating to make $150,000 profit, and they purchased that excavator before June 30 this year.
Yeah.
It's pretty much they pay zero tax, right? If they were estimating to make 150 profit, excavator, civil, that's 100% business use, they could potentially pay zero tax by purchasing that asset.
Yes.
But if they wait till July,
Yeah.
it's going to be different, right? With the new budget update.
Yeah, so basically COVID happened, a couple of years ago. It still is happening right now. But the government released some rules, and they basically said that, this depreciation rule of instant asset write-off, there used to be a limit of $20,000. It went up to $30,000, went up to $50,000 or something like that. But then they got rid of the limit completely and said there's no limit. And now it's called temporary expensing, where you get a full expensing, where you get to claim any asset used for business at $150K, $1 million. We allow you to claim the whole thing up front for that year. Wow. But that ended at 30 June. Well, that is ending at 30 June 2023. The budget just recently released, and they basically said that, hey, we're stopping that, but we're putting the limit back to $20,000.
And is it still the only to claim the depreciation of that value of that asset? So it's not a full deduction. So if they buy a 20K Bobcat, is that an instant 20K deduction, or is it just on the depreciation value for the ATO effective life?
As long as it's under $20,000, it's the instant, whole thing.
Yep.
But over it, then you have to claim it on the life cycle of the asset itself.
So it's a big difference, right?
Big difference.
Yeah.
So, if you're planning to spend money to purchase the equipment.
Yeah, if you're looking at scaling or growing, now is probably a good time.
Yes.
Especially if you don't want to complain about your tax bill.
Yeah, and the finance options, like you said to me recently, because we worked together for some mutual clients, and it's actually quite good right now. So you should be looking at, getting finances done before 30 June. It's actually a good move to do that because you get to claim it up front. And also, it's not even just heavy machinery. Right now, the federal budget released some rules where they're giving you an extra 20% on top of the 100% claim to claim on any energy efficient assets as well.
Wow.
Yeah.
So how does that work? So if someone was to purchase, I don't know, $100,000 worth of solar for their commercial premises under their business, they get 20% on top. So
so they get $120,000 claim. Yes.
Oh, wow.
But I don't know when exactly it starts. When
that was just released.
Yeah, it just got released recently. Yeah. So I don't know if it starts from the 1st of July or if it starts from the date of the budget. So got to check that. Yeah, I can let you guys know after. But basically, you get to claim 120%. And that was there was something like that back in the day. I think back in 2009 or something like that. There was something like that, but you get to claim like 150%. So this is a new rule that came out recently.
What's the threshold?
Threshold for that?
It's not 20K, right?
No, it was like 100K or something like that. Yeah.
Oh, okay.
Yeah, let me find out for you right now. I actually don't know where the heck it is. Give me a second. I have the notes here, guys. I have the notes. So it is up to $100,000 in total expenditure.
Yeah.
Yeah, and then eligible assets will need to be first used or installed from the 1st of July 2023 to 30th of June 2024. So starts from next financial year.
Yeah, okay.
Yeah.
What about business acquisitions? Do they fall under instant asset write-off?
Business acquisitions, instant asset write-off.
If you, let's just say, for instance, you're in transport, right? And you want to buy out a competitor.
Yep. So the weird thing is that a business itself is a capital asset for capital gains purposes, and it's not actually income for business or expenses for business. So therefore, you can't claim the instant asset write-off on it. You only get to claim the sale of claim the purchase of the business on the sale of the business.
What if the business has
trading stock?
30 trucks.
Yeah, so that's a different thing. So you're not buying the business, you're buying the equipment and the trading stock. That stuff there gets classed out of it. So when you when you actually sign a contract to buy a business, you'll always see this breakdown that the lawyers would ask. You would never understand what it is because you always the lawyers would go speak to your accountant and they would say plant and equipment portion and then goodwill portion, right? Yeah, that's what you always see. So the plant and equipment portion is, you get to claim the whole thing up front. But the goodwill part, which is the business purchase, technically is actually the purchase of the business. That part there gets written off only when you sell the business at a future date. So you can't claim that 100%. Or you can't even claim it against depreciation.
So if you're using the example of another transport company acquiring another transport company.
Yes.
You would provide that contract to the ATO if you were to do, say it was $1 million worth of trucks and 500K goodwill, right? You'll be able to give that contract to the ATO and say, look, we want an instant deduction of $1 million because in this contract, this business acquisition, a part of that deal is $1 million worth of trucks.
Yes.
That would work well?
So that will work well before 30 June 2023 because of that limit, the temporary full
guys need to hurry up and
purchase those businesses. But after that, then you wouldn't get to claim the whole thing, $1 million on equipment upfront anymore.
Did you have these conversations with customers? Like, you know that they're looking at expanding, they're looking at growing their business, acquiring other businesses. Did you ever mention that to the customers? Like,
so May and June is, and if you're not speaking to your accountant, then you need to, or you need to find someone that would speak to you during May and June. But May and June is the time where we speak to our clients and we do like an analysis of how much profit that we estimate they're going to make for the whole year and what are their future plans and what can we do to help them get to that plan in terms of tax savings or finances or how do we structure it. If you don't have that chat to your accountants, then mate, you need to, because that would help you save a lot in taxes, but also gear you up to be able to even purchase that asset.
And help you scale your business, right?
Yeah.
You know, if you're making a big profit and you're looking at taking your business to the next level, why not capitalize now before June 30 and get an instant deduction and getting assets that are going to be income generating for your business to help you scale?
Yeah, because you're going to spend it anyway. That's the thing. Like 6 months time, you knew you were going to buy this business. Yeah. You just didn't act on it straight away. But now this is like definitely like what you pinpointed is definitely something that you need to do like ASAP before 30 June. And you don't have much time, mate. Like 2 months to do a due diligence on a business and then purchase it and get it transacted before 30 June. You really don't have that much time. You probably have to get finance too. So probably if you speak to Odin Finance, you'll get it in 24 hours.
Yeah.
But yeah,
that's good. Yeah. What can I do for my business? Like, you know, we're in finance. Like, I'm just curious about it. If I was to invest 200K in a software, right? This is an example. Like, can I get an instant deduction if I purchase 200K worth of software before June 30? Or is there limitations to it? And what are the limitations when it comes to other things? Obviously, you know, transport, trucks, that makes sense. But finance company or a service-based business looking at upgrading their systems.
Yeah.
What are the limitations when it comes to, you know, purchasing this software to get that instant deduction?
Software is very complicated, and I'll tell you why. It's because there's so many different layers of different types of software. So if you're building your own software and you're spending money on research and development, that there is considered like intellectual property.
But if you do a Salesforce thing, that won't count.
Yeah. So if you're building if you're buying off the shelf software like Salesforce, for example, you get to claim the whole thing up front.
Oh, you can?
Yes.
Right, that's cool.
Like because it's a off the shelf software that you're paying a subscription fee on an annual basis, and then you pay consulting fees to implement it into your business. Yeah. So that the tax office sees it as like annual costs or that you get a claim up front. It might even not be considered plant and equipment or asset. It's actually just expensed. Something that you spend once and you get to utilize it straight away. Okay. That's why I'm saying there's so many layers of software. Then there's another software where you're in a software development business and you're building software that is the bread and butter of your business, and you sell that software to other people. Then it's like an asset. So you can't even actually claim. You get to claim it, but you only claim it on the life cycle of it, and that life cycle is kind of like depreciated over amortized for a very long time too, because you're always constantly spending money. But then there's always grants because the tax office loves people building software because it promotes more jobs and
R&D. But we won't get into all that, right?
So that's what I'm saying. Like software is very complicated, but we could use another example if you're curious on.
Give us one. Yeah.
So, for example, if you want to invest in your business, like most people would spend on like vehicles or heavy machinery, even like furniture fit outs or office fit outs, that can be claimed as well. And it can be, some parts can be instant asset written off if it's like not actually part of the building, but just repairs or fixtures and fittings and aircon or glass that can be claimed. So they're all different things you can claim, but you got to get an expert in there to like do a valuation on the actual equipment that you're spending on or the renovations you're spending on, and you can claim that as well. So I think you can get finance for like renovations as well. So if you're planning to do something like that, you got to do it before 30 June.
Yeah, 100%. I think it's a no-brainer. Davie, thanks so much for coming on board. Yeah, it was really good. Davie, you're my accountant, and we really appreciate everything you've done. And, you know, if anyone needs a good accountant, I can highly recommend not just you, but your whole team. So thank you.
Thanks, mate. Yeah. So if you need to find us, our website's boxas.com.au, stands for Box Advisory Services. And like, you know, you can pretty much contact us or give us a call. You can Google search us. We're
You're
pretty much
everywhere online.
Yeah, I was gonna say
You're
we're everywhere.
online.
We also have a YouTube channel that we release videos about this. We actually have a very popular video about like purchasing cars and financing it or interest. Yeah. Yeah. So you probably send it to some of your clients.
Yeah, I have.
Yeah. So check that out, guys. But yeah, thanks very much for having me, Louis. This has been fun. First one for the year and probably more. So invite me to your next one.
Yeah, no, definitely, man. Thanks,
great.
Davie. Appreciate it, man.